talking about Apple. And first I want to start, the two big takeaways here is that Apple, we think, is going to become more of a services business over the next several years. That's going to take a big shift in terms of how they approach the market, a negative impact on profitability, but ultimately a longer impact on growth and visibility. Second is we think that there are two big markets that they can go after, which is augmented reality and also auto. So there is hope around future market segments. One big misconception is that Apple's missing everything and they're just not growing. And part of this comes from investors looking at the growth rates, and it's been pretty low over the last couple of years. But if you look at the market cap of Apple, it's down 4% in the last 2 years, where Google's up 42% and Facebook is up 52%. And that kind of fuels this belief. There is one thing that Apple has missed, which is the low-end phone market. And I think the key takeaway there is that we think that they can approach that market with more of a services-first approach. Moving to the iPhone, it's 66% of revenue. It's 73% of earnings. Ultimately, this is a big segment for obvious reasons. In terms of the growth rate, it's stepped up with the iPhone 6 and at 37%, and it's dropped back off. It's down 10% more recently. We do expect that the iPhone to try to lower off in terms, or steady off in terms of the growth rate at 10%, in part because the upgrade cycle, we think, ultimately is going to be more powerful. The lag between upgrades has been extending, and people are holding on to their phones longer. It's now 33 months versus before it was 28 months. ASPs on the iPhone jumped up with the iPhone 6, but they've been kind of all over the place in the last 2 years. Moving forward to the near term, one of the reasons why we're optimistic about the iPhone is that everyone still wants an iPhone. It's not about a big feature. It's just in general, it's high on the wish list. Our consumer team showed that 7% of people want an iPhone this holiday versus 5% a year ago. That's the highest ranked product of any product that's on the wish list for the holiday. The number 2 is the the Mac at 2%, and the number 3 is the Xbox at 1%. And so this whole theme that Apple doesn't have exciting products isn't necessarily resonating with consumers when they think about things that they're going to invest in. Unfortunately, you're going to have to wait for that iPhone because the lead times are a couple weeks. One of the other reasons why we're positive about the iPhone more longer term is this massive wave of upgrades that's coming. The longer that people hold on to their iPhones, the bigger the base of the upgrades. And we can go through and model that out. And that base is going to reach around 300 million units in the next few years. To put that 300 million units into perspective is that Apple has, at their peak in the iPhone 6, they did 235 million. So in other words, is this big base of old iPhones essentially should carry the iPhone growth for the next couple of years. In terms of the iPhone 10, there's a lot of focus on what the expectations, obviously OLED, which would be a wraparound screen. It would look more futuristic. VR and AR is another piece. Apple's been talking more about AR recently, and we think that they can shift from their typical playbook of being a fast follower to actually innovating around AR with the iPhone 10. The AR, the device of choice, is going to be the phone for the next 5 years. Eventually it moves to a wearable. But right now with the iPhone 7 Plus, the dual camera, there's depth mapping, so they can do more with AR. But look for that to be one of the key differentiating features, not just it looks a little bit different, but the whole AR theme with the iPhone 10. Shifting to services, this is really our big takeaway, is that services right now is 12% of revenue. It's going to be a $28 billion business next year. That compares to Facebook, which is expected to be a $36 billion business. The primary part of the services business is the App Store at 60%. The other is iTunes. And then the balance, 25%, is iCloud, AppleCare, and Google. That's the Google search revenue. Apple Pay is in there, but it's so small it really doesn't add up. The growth rates are particularly impressive around services. Even though the numbers are getting higher and more difficult, the comps are getting more difficult, the growth rate has been accelerating. We're modeling for it to go from 17 to 12% next year, but that's pretty conservative. I think that there's reason that this can be a much bigger business, as we talked about. There's a little boost that the services business is going to get on December 15th with Super Mario Run, which will be a $10 app. They're also being more aggressive in terms of buying apps and trying to sell you different services. Here's one for a $240 a year option for cloud storage. But overall, apps are just generally getting more expensive. If you look at the top selling apps on desktop right now, there's a $300 for Final Cut, $200 Logic Pro. Dropbox has a $750 Pro option. It's an annual subscription. Apple takes 15% of that, so just over $100, and that's pure margin. On the phone side, it tends to be more gaming. Just looking at Pokemon, you can buy Pokemon coins from $1 package to $100 packages. But the concept of how people are spending and the amount that they're spending is increasing. The key takeaway from today's presentation is what we're suggesting Apple do, not the fact that they're going to do this, but to shift to a services model. Right now, Apple is profit first, which means they try to make a lot of money when they sell phones. That's resulted in small market share in the world for their phones, but they have the majority of the global hardware profits. Overall, they have a 20% operating margin. Profit first is very different than the right approach, which is product first. That's basically what Google and Facebook do. And in a product first approach, they try to build user bases. Examples would be WhatsApp and Google Maps. And by doing that, it yields much higher margins. So when you put this together, we think as Apple focuses more on services, it can be a more profitable business. Today, we think that it has a 40% operating margin, about 50% higher than the overall Apple business. So how could they actually do this? And one thing is that they could grow their current 1 billion active devices and the $37 a year per user. And the way they do that is by reducing the price of the iPhone, potentially doubling the market share of the iPhone. This would cause their current stronghold in the US and Western Europe to expand to Latin America, Eastern Europe, and Asia. And ultimately, we think this is going to be a more profitable, more sustainable business that investors will reward. Quickly moving to the Mac, it's 10% of business, the third largest market. The growth has been declining for the last couple of years, but now with the new versions of the MacBook, it should jump up for next year. One impressive stat around the Mac is for the last 15 years, the ASPs have been astonishingly resilient. They're down 14% during that time, which is a surprise. The iPad, now 9% of revenue. The growth has been all over the board. It bottomed out last year in 2015 at down 22%. It's a little bit better in 2016, but we're still expecting it to be down about 10% this year. The ASP saw a bump up with the iPad Pro, but they're still all over the board. The takeaway from the iPad is that this is probably not really a growing business longer term. It's just generally going to be flat. But it is an important part of the story because when we think about the services approach, it's an important part of how people interact with the web. Moving to the watch, we're expecting 18 million units next year, or $9 billion. That means that the business compares to Fitbit, which is about $2.5 billion. So this is a big business. It's basically 3% of Apple, hidden within Apple. Their key focus today is activity, but ultimately we think that they're going to shift to more of a wellness product. We would expect more healthcare providers to start to issue watches to people for better wellness. And Apple TV, if you would have asked me 5 years ago if I would be looking at this slide today, I would find that hard to believe. In fact, it is just a hockey puck. But they have a nice play here in terms of how they're selling content. And specifically is that the top 3 grossing apps in Apple TV are HBO, Netflix, and Hulu. So this is part of that broader ecosystem. In general, we think they've sold about 40 million Apple TVs over the last 9 years. And quickly on Apple Pay, it doesn't really matter in terms of the size of Apple's business, but it's important in terms of the experience. Apple Pay in September was up 500% year over year, the number of transactions. The number of transactions in the month of September equaled the previous 12 months combined. And now it's available in browser, so you can use it in your desktop. There's several 100,000 of those websites that allow you to do it in desktop. And here I'm buying a pair of socks. I want to note that once you select the size of the socks, a buy button comes up immediately. You don't even deal with a checkout or an express checkout. It's right there. Retailers don't want you to abandon, and they want you to purchase as soon as you're in that mode. That total transaction took 10 seconds. PayPal is in trouble. As we look at the top 100 retailers, we're seeing those retailers starting to shift away from PayPal and starting to emphasize this better experience for iOS. And just quickly, in terms of the future, we know that they go through products where they start small and get very big. Fun to think back that the iPod one day was 50% of business. Today it's 1%. But the 3 key areas of focus is they're going to be ramping up their R&D spend. Apple's growing R&D faster than their revenue. They're going to spend about $10 billion in R&D versus Google at about $13 billion. And the 3 areas that they're going to be focused on, we think, for new categories. One is foldable phones. The idea is there's bendable glass today. By putting a charge through it, you can make it strong. Eventually, your phone and your tablet get replaced with some sort of foldable device several years. AR is a huge deal. Next version of AR for 5 years is your phone. Eventually, it's going to be a wearable. This is important because the way we interface with machines is changing. It's going beyond a crude interface of a touch screen to more intuitive voice, a gesture, a gaze, even your thoughts to drive that. And lastly is auto, a topic we approach with some hesitation of our lessons in the past. Because Apple's investing in something doesn't mean that it's going to see the light of day, but it is a big market. And just point out the real market here isn't the opportunity for Tesla to sell 500,000 vehicles in 2018. The real market is a change in terms of how people are using transportation. SurveyMonkey estimates there's 20 million monthly subscribers for Uber and Lyft. And that is the opportunity where eventually transportation is going to go to the ride sharing. And they obviously have this letter that was released last week that the Wall Street Journal was reporting on. There's a debate, are they going to build a car? Are they going to be the brains behind it? We lean to they're going to build a car because they still want to do a lot of the hardware and the software. So that's Apple in a wrap.
Let's hear it for Gene.